Hey guys, it is Sunday, May 5th. Bitcoin's back up to 64,000, and I just want to talk a little bit. It might be a little longer episode, but I want to give you sort of my economic framework as first of all, as a person who's been in the financial markets for, let's call it 30 plus years, and who a person who's been in crypto for almost almost coming on 6-7 years now, and who was on Wall Street as a bond trader for 6 years, right? So that's sort of my background and how I approach things. And what I haven't done very well is articulate exactly how I view the economy, and how Bitcoin fits into sort of this money printing narrative. So I want to go back, and I really want to dive into kind of my economic view of kind of the history of really the last 100 years. So I'm going to start with the Great Depression and FDR. So under FDR in 1933, we had this Executive Order 6102, where basically FDR said, you have to turn in your gold to me. You can't hold gold in private hands. And he got about half the gold, apparently. But he basically stopped people from saving in gold during the Great Depression. And that was critical to his plan, because his plan was basically to start spending all kinds of huge projects. And, this of course led to, the Hoover Dam and all these kind of other New Deal projects. But right up until the Second World War, and at that point, the entire U.S. economy was turned into a war machine. So Detroit stopped making cars; it made tanks, and the Stephanie Kelton in her movie Finding the Money just loves this. She's like, "This is amazing. This is how great America could be. We're just turned into this super productive economy." This is really kind of the socialistic dream of, we're all going together and we're building stuff, and the government's coming up with this great list of things to do, and it all just works, right? Well, it didn't all just work. Basically, we had gone into this state-run socialism right through the Second World War, and and we came out of the Second World War as kind of the only economy standing, right? So after that, we had we had Eisenhower, we had who was a Republican, right? And then we had Johnson and Kennedy, so we had a lot of Democratic spending programs there. And then finally we had Nixon, who finally abolished the gold standard in 1971. And 3 years later, we had Ford, who at the end of 1974 reversed the Executive Order 6102. So why was this all so significant? Well, we had this period of kind of quasi-socialism and really this Cold War with Russia, right? And if you haven't seen this documentary on Netflix called The Turning Point, I would recommend it, because the threat of nuclear annihilation was so severe in the 50s that the U.S. had become this, even after the Second World War, we had just spent so much of our economy was diverted into this military-industrial complex that was fighting the Cold War, right? And that really ended in the 70s, right? That it sort of or had taken a different turn in the 70s. So we had this the end of the gold standard and the end of 6102, all within a 4-year time frame. And the net impact of this was people could now buy gold for the first time, and the price of gold went up from under $200 to about $600. So it went up 3.5 times in a period of 5 years. So just this massive increase in the price of gold, massive increase in inflation. So we were having double-digit inflation. We had OPEC in 1974 as well. So we had this oil price shock. It was just a god-awful period. And the Fed didn't know what to do with it, and so they raised rates, they lowered rates, and then finally Volcker came in and just raised them up to 17%. And that was enough to choke the economy. That was enough to drive all the money into financial assets. And gold peaked at $600, a little over $600 in 1981. And it entered into a bear market for about 40 years. From 1980 to 2020, gold was in a bear market. For 10 years. From 1980 to 20 years, from 1980 to 2002. Those 20 years, gold was in a bear market, and the Fed started relentlessly lowering interest rates. Okay, so who controls interest rates? The Fed controls interest rates. That's who controls interest rates. Long-term rates are expectations of shorter-term rates. So if you have a 3-year note, okay, what's the yield on that? Well, a market determines the price, but at the end of the day, you have an option to just hold short-term rates or hold the bond, the 3-year note, and over 3 years, one of those two will win. So it's really an expectation of future rates. So if the Fed signals very aggressively that they're going to continue lowering rates, it will impact longer-term rates as well. And then the Fed can, of course, buy notes. They can buy notes and bonds, and they have in the past as well. So these things are not free markets. They're manipulated markets, and they are heavily driven by the Fed. So let's just keep that in the back of our mind. So now we have the Fed that is under different administrations, Republican and Democrat, that is lowering interest rates, right? We have this other, and so this is fantastic and we have under Reagan, and then there's this whole engine of deregulation that happened starting in 1980. And this combination of low interest rates, deregulation, sort of hands-off, do what you want, laissez-faire, this is exactly this is the recipe for how you do well as an economy. And the U.S. economy did amazing. It's just those were the golden years of the American economy, I would say, from 1985 to, let's call it 2000. Right? Those 2 decades were amazing, right? And culminated with the internet boom, and then the crash of 2000. Okay, so my timing was pretty good because I was on Wall Street kind of during the peak years of the late 80s, early 90s, and then I moved to tech, and I started creating tech companies. Well, nobody was creating tech companies. And I've had a lot of exits in the tech side. I made actually a lot more money in tech than I ever did on Wall Street. Although I did make a lot of money on Wall Street too. But anyways, after 2000, we had this crash, right? And we started now fueling the real estate bubble. Now, it's very important to understand that all this money printing, right, which is lowering of interest rates, increasing the debt like crazy during this period, had one impact. it all went into assets, right? It didn't go into inflation so much because we had this sort of globalistic deflation from technology and from just outsourcing a lot of stuff to Japan initially and then China. So inflation was under control, but asset inflation was not under control. And so the money flows to the harder asset. That's what happened, okay, in the 80s. And so where did the money go? Well, the money went into stocks, right? Because stocks now bought back their own shares. Stocks could borrow long-term in the credit markets very cheaply, right? So they could fund themselves in the debt markets, and then they could use that funding to buy back their own shares, which increased their share price, right? So this was a virtuous cycle that lasted about a good 20 years. Now, and then in real estate from 2000 to 2007, 2008 was in a similar type of bubble, right? So we just sort of moved the speculative thing into the real estate market, and all of a sudden you had these super low rates that were just used to buy up, condos and houses in Florida, and that was well documented in The Big Short. So we have this this money that was this excess money printing. Where did it go? Well, it went into asset prices. It created the stock market bubble, the internet bubble of 2000. It created the housing bubble of 2008. And then we finally kind of got to the end of the road in sort of 2008. And that was a period where the government, again, stepped into something that they had never done, which was this QE, right? This is sort of the ultimate expression of fiat craziness, which is quantitative easing. And basically, at this point, we're sort of veering into what's now called MMT, which is just we don't need to tax. We can do whatever we want. We'll just print money. We'll print the dollars, and let's just not worry about deficits. It doesn't matter. Those deficits don't matter. They're just zeros and ones on some registrar, and let's just decide all these great things that we want to do with our economy, and we'll just print money, and hopefully that won't cause too much inflation. Well, this is nuts because it will. And it was exactly during that time that Bitcoin finally got invented. Now, it was clear to me that people had sort of sensed this. This was a huge problem in cryptocurrency circles before that. And there's these attempts to build something like Bitcoin, as early as 1998, right, when Nick Szabo created BitGold and Wei Dai created B-money, right? These were sort of ideas of currencies. They didn't quite get it. It parts of the element, you had the hashes, you had this idea of a registrar, sort of a public registrar of transactions, you had the ability of sending money. You had even the idea of mining rewards, right? That these rewards were done, but you didn't have the idea of blocks. You didn't have the idea of a difficulty adjustment, which kind of kept these things very regular. You didn't have this idea of a finite amount of currency. So these were all completely new ideas that Satoshi came up with in 2008. But it was fortuitous. I think that Satoshi found the solution right at the peak of where the insanity was about to take a new inflection point, which is this quantitative easing. So why do I think right now we're in such an amazing, interesting position? Well, unlike the 1940s, right? We do have options now. If you have money, you can easily move that money to Bitcoin. You can easily move that money overseas. You didn't even have in the 40s, really. Americans didn't invest in other countries. This was just sort of a newer concept. Americans invested in America, right? That was the case. And even in my early days on Wall Street, emerging markets were such a very odd thing to put your money in. I have my friend Guy Elliott, who made the front cover of Barron's with his Croesus fund, was one of the few people kind of going out there and investing in Africa, investing in Brazil and places like this. And it was considered extremely exotic to do that in the 80s and 90s. So people didn't have foreign investments. The idea of putting your money in Bitcoin would be crazy. But we now have alternatives, right? And things happen really, really fast. So as we've seen with these bank failures with Silicon Valley Bank and so on, things can happen very quickly. People can move monies with clicks of a mouse right now. And so I think there's no going back. And people will buy Bitcoin and they will protect their wealth. It's just a game theory thing. So I think we are in this unbelievable spot where, the politicians are about to enter into something like QE again, something just completely insane. These deficits are going to go so high that, as Larry Lepard would say, it's going to make your eyes bleed. We're now doing $2 trillion in deficits a year. I mean, I remember when Reagan did the first $100 billion deficit, and that was considered just absolutely insane. And now we're doing a $2 trillion deficit. It makes no sense. This is not like, we're not like in a completely different world than we were in 1988. I remember 1988 quite well. I had a suit on and I was in Wall Street in 1988. It's not like some foreign country. I remember the cost of things in 1988. I remember you could buy a McDonald's burger was $2. Now it's maybe $4, but it's not 10 times the price difference. But yet the deficit is 10, 20 times bigger. So we have really gone into this completely crazy times. And I just want to conclude by saying, look, you should watch this Stephanie Kelton MMT thing, because it's just clear to me that this is the kind of insanity that we are likely to see with the Democratic Party. And maybe even with some version of the Republican Party, I'm not sure. But the fact that this kind of insanity is even considered, to me, tells me all you need to know about buying Bitcoin. You need to get your Bitcoin. And I would argue that it'd be good to get quite a bit of it even off the ETF. Self-custodied Bitcoin, get it off the grid, get it available to move if you need to move. There really is a danger here that we are on. We're on the Titanic, and you may need to find a new boat. Money can move now. You can move. You can physically move, and that's if you've got enough Bitcoin, you can always move somewhere else. There's always a very nice place for you to move to with enough Bitcoin. Anyways, that's my rant of today. And I hope you guys enjoyed it, and I hope it wasn't too long. And if you like my content, please subscribe to my YouTube channel. I just crossed 10,000 subscribers, but I want to get some more, just because I want to get more interesting people to pay attention and to want to join, and so we can have these arguments, so I can promote Bitcoin better to people who may not even be in Bitcoin right now, and I can have those conversations. They'll take me more seriously. So thanks again, and we'll see you in the next episode.